The Singapore economy is being clearly affected by the global slowdown in manufacturing, trade, and investment. The economy grew by 1.2% in Q1 this year, compared to 3.1% for full year 2018. Recent indicators suggest that growth in Q2 could be lower than in Q1. Non-oil domestic exports have contracted by 9.3% since the beginning of this year. The manufacturing sector is in a sharp downturn. GDP growth for the year as a whole is likely to be weaker than earlier envisaged. MTI and MAS are reviewing the 1.5 to 2.5% forecast range for this year's GDP growth. Growth in the first half of the year is looking to be quite weak, particularly in the trade-related sectors. Currently, the full year forecast is premised on the economy stabilizing in the third quarter of 2019 with a modest pickup thereafter. But the strength of this pickup, given the softer external environment and ongoing trade conflict, is unlikely to offset the weakness in the first half. And downside risks, as I said, have clearly increased. But as with the global economy, it is important to look beyond the headline growth numbers and assess the composition of growth in the domestic economy. Last year, Singapore's GDP growth was driven by two engines: the trade-related cluster and modern services cluster, with domestic services flat. The trade-related cluster, which is manufacturing, wholesale trade, transport, and storage, grew 4.3%, contributed 55% to overall GDP. The modern services cluster, financial, information and communications, and professional services, also grew 4.3%, contributed 40% to overall GDP. Growth in the domestic industries cluster, construction, retail and F&B, health and education services, was negligible, mostly weighed down by the slump in construction. This year, the trade-related cluster is decelerating, modern services is holding up, and the domestic industries cluster is gradually recovering. The trade-related cluster will continue to face the brunt of the maturing of the global tech cycle and growing trade tensions. The modern services cluster will be the main driver of growth this year, supported by healthy regional demand and increased investments in digitalization as the domestic economy undergoes transformation. Domestic industries will make a modest positive contribution to overall growth as the construction sector turns around and retail and F&B benefits from firm labor demand conditions and efforts to lift productivity. Inflation in Singapore remains subdued and within expectations. MAS core inflation this year is expected to come in near the midpoint of the forecast range of 1 to 2%. While there are some domestic cost pressures from firm labor market conditions, underlying inflationary pressures should remain contained. First, the slower pace of GDP this year is expected to close the positive output gap. In recent years, GDP was growing faster than potential. Second, the fall in global oil prices in Q4 last year and the deregulation of the electricity distribution market have exerted a dampening effect on inflation. Third, the 2 rounds of monetary policy tightening last year by MAS will continue to have a restraining effect on inflation. CPI all items inflation for the year is projected to be between 0.5 and 1.5%. Private road transport costs will pick up slightly from 2018 with higher car prices, more than offsetting lower petrol prices. Accommodation costs are likely to decline, but at a slower pace this year. Overall inflation in Singapore remains well below the historical average. MAS's monetary policy stance remains appropriate against the backdrop of subdued inflation and weakening growth prospects. Last year, MAS began the process of monetary policy normalization by exiting from the 0% appreciation part of the nominal effective exchange rate policy band. MAS increased slightly the slope of the policy band in April 2018 and again in October 2018. Against the backdrop of healthy economic growth and gradually rising inflation. In April this year, with inflationary pressures stabilizing and the output gap beginning to narrow, MAS kept the policy stance unchanged. Our current stance of a modest and gradual appreciation path of the Singapore dollar nominal effective exchange rate policy band will help to keep the economy close to potential and ensure medium-term price stability. Globally, risks to financial stability remain elevated amidst high levels of indebtedness. In the Eurozone, the large exposure of banks to government securities means the risk of a sovereign bank debt crisis remains. In the US, corporate debt has increased by 30% since the global financial crisis, with a sizable allocation of credit to highly leveraged corporates. In China, the total leverage in the system is about 300% of GDP, with high levels of indebtedness among local governments, state-owned enterprises, and households. In Asia, there has been a surge in the issuance of foreign currency bonds, denominated mainly in US dollars and concentrated in the real estate sector. Now, high leverage in itself does not suggest an impending financial crisis. But if coupled with a sudden shift in investor sentiment, can lead to financial instability. The potential triggers for such a sudden shift in investor sentiment are not hard to find. Escalation of trade tensions, disorderly Brexit, sharp slowdown in China, or unexpected tightening of financial conditions. In Asia, the key risk is an abrupt reversal of portfolio flows and consequent stresses on indebted corporates with large foreign currency liabilities. Singapore's financial system, corporate and household fundamentals remain sound. MAS's most recent stress tests indicate that our financial system is resilient to an adverse scenario of severe global downturn as a fallout from the rising trade tensions. That said, continued vigilance is warranted. Some households and some corporates could face pressures on their cash flows and hence debt servicing capability if the economy slows more than expected. Last July, the government took macro-prudential measures to cool a property market that was showing early signs of potential overheating. In less than 1 year, between Q3 2017 and Q2 2018, private residential prices had surged by 9%, offsetting most of the gradual decline of 12% over the preceding 4 years since Q3 2013. There was a real possibility that property price increases would once again run ahead of economic fundamentals as they did in the lead up to 2013. If a renewed property bubble were to form, it would risk a destabilizing correction later on that would hurt households, businesses, and the banks. This risk was especially pertinent given the strong pipeline of private housing supply coming on stream over the next few years. This is why the Ministry of National Development, Ministry of Finance, and the MAS decided to act early and decisively to restrain the property market. We have learned from experience that preventing a bubble from forming is less painful than deflating one that is fully formed. The measures implemented last year have helped to moderate the property market cycle. Since Q2 last year, private residential price increases have eased significantly, and average transaction volumes have fallen by 30%. Bids for land tenders in both the en bloc sale and the government land sales markets have become sober. The government's aim is not to depress property prices, but to promote a stable and sustainable market. The government does not have a target rate of increase for property prices, nor can it manage the cycle too tightly. But the government does have a role to help ensure that price movements are broadly consistent with economic fundamentals. In an economy that is growing in nominal terms at 3 to 5%, it is not sustainable to have property prices increasing at double digits. So the government will continue to monitor the property market closely and stands ready to help ensure a sustainable and healthy market.